Let's start with something that feels small but actually matters a lot. We didn't get a Santa Claus rally at the end of 2025. Now, that doesn't mean the market is about to crash, but it does tell us something about tone, psychology, and positioning as we head into 2026. When markets want to go up, they usually don't miss easy excuses to do so, especially during the holidays, when liquidity is thin and sentiment is supposed to be optimistic. Instead, what we saw was hesitation. Selling pressure showed up even when it shouldn't have. That's usually a signal that investors are already uneasy about what's ahead. Rates, growth, earnings, geopolitics, or some mix of all four. So in this video, I want to explain why the market feels stuck, why trends aren't working, and why 2026 may be less about chasing direction and more about managing volatility. This isn't a doom story, but it is a caution story. Another reason the market feels strange right now is liquidity, or more accurately, the lack of it. We just came through 2 holiday-shortened weeks. Trading desks were empty. Volumes were extremely light. In that environment, price action lies. You get breakouts that fail, breakdowns that reverse, big candles that mean nothing once real money comes back. That's why I'm very cautious about drawing conclusions from late December or early January moves. Large institutions, pensions, hedge funds, global allocators haven't fully shown their hand yet. Historically, the real direction of the year tends to reveal itself after the first full trading week of January, when liquidity normalizes. Until then, we're mostly seeing noise. So patience here is not a weakness, it's a strategy. One of the clearest reasons indexes are going nowhere is sector conflict. This isn't a market where everything is weak or everything is strong. It's split right down the middle. On one side, you've got technology, financials, healthcare, and consumer discretionary struggling. These are growth-sensitive sectors. When they weaken, it caps index upside. On the other side, you've got energy, utilities, materials, and industrials holding up well. Some of this is inflation hedging. Some of it is defensive positioning. Some of it is late-cycle behavior. The problem is, these forces cancel each other out. Money rotates instead of expands. That's how you get what traders call barcode markets, up one day, straight back down the next. Until leadership becomes clear, chasing index direction is frustrating and usually unprofitable. Technically, the market is also flashing yellow lights. The S&P 500 is stuck inside a wedge. That means buyers and sellers are compressing price, and the middle of that structure offers no edge. Gradual new highs might look bullish, but without volume and follow-through, they're fragile. In fact, slow grind-ups often resolve lower once support breaks. The Nasdaq 100 is even more concerning. It's printing lower highs, which tells us tech leadership is weakening. And tech is still the engine of this market. When mega-cap leaders like Amazon, Google, and Meta fail breakouts, it creates a leadership vacuum. Markets can't trend higher without generals. Right now, we don't have any. Technically, the market is also flashing yellow lights. The S&P 500 is stuck inside a wedge. That means buyers and sellers are compressing price, and the middle of that structure offers no edge. Gradual new highs might look bullish, but without volume and follow-through, they're fragile. In fact, slow grind-ups often resolve lower once support breaks. The Nasdaq 100 is even more concerning. It's printing lower highs, which tells us tech leadership is weakening. And tech is still the engine of this market. When mega-cap leaders like Amazon, Google, and Meta fail breakouts, it creates a leadership vacuum. Markets can't trend higher without generals. Right now, we don't have any. So what do you do in a market like this? You stop forcing direction. This is not a clean trend environment. It's a volatility environment. That means strategies shift. Selling high implied volatility can outperform chasing breakouts. Focusing on stocks you'd actually be willing to own matters more than guessing the index's next move. On the crypto side, Bitcoin is approaching a key zone around $91,500 to $92,000. That area matters technically and psychologically. But even here, leverage is the enemy. Over-leveraged proxies like MicroStrategy amplify pain when volatility spikes. If you're trading options, higher beta names like Coinbase often offer cleaner structures and better risk control. The big picture takeaway is this: 2026 may reward discipline more than conviction. Let the market prove direction before you commit. Until then, trade the range, not the story.